Target Corporation, ticker symbol TGT, is currently trading at $93.70 a share. If we look at the stock over the last year, you can see it's down about 43%, and over the last 5 years, it's down actually 18%. It had its highs back in 2021, has had a big decline since then. Is this the right time to buy? Well, that is the question we're going to be answering today. We're going to be looking at Target's most recent financials and then taking it to my automated stock valuation spreadsheet, seeing if it's a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. Let's just first put in the ticker Target, or TGT, and we'll let this load up. But just quickly going through the share price, as I said, it did have its highs in the mid of 21 and it has down. It was previously had some lows of $107 a share, made a pretty big uptick there. It was about 60%, but has had pretty consistent sell-off in the recent time. Everyone else in the market had that big jump off in mid-February. Target didn't have that steep decline, but has had a slow, steady bleed. So we have Target Corp, $92 a share, market cap 42 billion, P ratio of 10.5, which is a lot lower than the market average, which is just 26. Earnings per share $8.86, and a beta of 1.3, meaning it's more volatile than the market. Analysts, interestingly, still do have it as a buy at $130 a share. Now, it pays a very healthy dividend yield at the minute, 4.83%, which nets you $4.48 a share. In terms of the dividend, is it safe? Yes, it is. About 50% of the net income and free cash flow payout ratios, with a dividend of $2 billion. Buy before the 14th of May to get paid your quarterly dividend. So let's have a look at revenues. This is, ignore the trailing 12 months here because it adds up the last numbers, but it's the full year 25 numbers, 106.57 billion, and you can see it is declining. Now, if we go to the most recent earnings, this is, one second, let me scroll up. Target, scroll down. We have a cool black screen, which is nicer. Yeah, you can see here, let me zoom out one more tick. Keep going, zooming out. Oh, Target, you moved. I have to scroll on this. Well, we have net sales here. This is 3 months ended, 24-23, and then the 12 months ended. Yeah, so you can see February 24, 107.4 billion, down 106.6. 1% decrease, and then we have the 3 months ended 32-31, which is obviously what we are seeing here, but then this is the 106 billion. So if we also scroll down, we can see the different sections. Let me go a little bit further down here. It is the different, there we go. So this is the different sections that they have: apparel and accessories, beauty, food and beverage, hard lines, home furniture and decor, household essentials, and other. And we will look at the 12 months ended. Biggest section of Target is currently food and beverage. That had a slight decline on the year. Next largest section is home furniture and decor. That had a much bigger decline of about $1 billion. Oh, sorry, household essentials next. 100 million decline. Beauty is up, which is good, and apparel and accessories is up ever so slightly, but their major food and beverages have been down, household essentials down, so everything is down apart from a couple, which is why the net sales has decreased. So this is not what we want to see. Net income, are they able to generate more profit? 4.1 billion, so down slightly again. They did have that big jump up in 22, which looks like a bit of an outlier. The share price run up, as we saw. 23 was down massively and then flat the last 2 years. Free cash flow, similar story, although actually increasing it slightly, 4.48 billion. If we look at operating cash flow versus capex, you can see that operating cash flow is down, but capex is down massively as well, which is why the free cash flow has increased. If capex was the same, then free cash flow would have been down. Just outstanding. Historically been buying back, but it has dropped off recently. So let's have a look at the discounted free cash flow model. This is a way of buying stocks, looking at their future free cash flows, count them days value, and actually gives us a price of 190. So a massive buy, but with the free cash flow ratio of being about 11 and the average free cash flow 11, that's not a surprise. Let's have a deeper dive and see what we think. So it is still currently giving us positive revenue with 109 and 111 billion in the coming years. Let's see what analysts agree. Analysts are also expecting on the high side, even on the low side, they're still expecting positive revenue growth. So that is quite interesting. Overall estimates on the growth is about 7.5, but yeah, they're still expecting positive revenue growth. So let's just bring this down a bit. We'll bring it down to 1%. $108 a share, 180, sorry. Net income margins, yeah, these are way too high. Let's bring this down to 3.8. Puts it $160 a share. And net income to free cash flow. I mean, I don't hate this number looking at what we've seen, apart from 23. So we'll even bring it down a bit more bearish. Oh, wish 850%, 85%. Still puts it at $140 a share. And this was declining revenues. Now, if revenues were declining at say minus 5% a year, you know, it's still a buy according to discount and free cash flow model, but less of a buy. So that's quite interesting to see. If you're interested, please check out my Patreon. It's a $4 tier. This gives you full access to the sheet and you can do your own stock reviews. Next, we'll have a look at the dividend discount model, see what that does. Target obviously does pay a healthy dividend. Growth is all over the place, but I just do the 3%. And we'll copy the weighted average cost of capital here. I mean, if they grow it at about anywhere between 3 and 3.5%, it will be a buy, which they were doing, but now you can see it's dropped to about, sub 1%, sub 2%, which puts it undervalued about $70 a share. So target need to keep increasing their dividend if possible. Now it is safe, as we said before, but yeah, 3% increases per year would put this at about fairly valued. Ben Graham formula for intrinsic value. This looks at the earnings per share PE of a non-growth company, AAA bond yield and corporate bond yield, and currently 5.29. And I think we saw that the growth was at about 7.65%. Oops. There we go. Lost it. 7.65%. So actually, $120 a share and a Graham price of 90, which is pretty much where it's valued. So Ben Graham would be purchasing this as well based on that model. So despite it being dropping down, one model, discount free cash flow model, says it's a buy. Dividend discount model says it's borderline, and Ben Graham says it's about a buy as well. So finally, let's have a look at the comparable company model. This is where buying stocks looking at their competitors. Firstly, we'll do the sort of the premium companies here, WMT and Costco. And we'll just compare to these two specifically, and then we have a few more that we can compare to Kroger, Dollar General, and BJ's Wholesale. So we'll just compare against these two specifically. Looks at enterprise value, revenue growth rates, net income, profit margins, price to sales, price to book, PEG, Peter Lynch's price earnings growth, EV to revenue, EV to EBITDA, PE, and forward PE. Now compared to Walmart and Costco, smallest company, yes. Higher 5-year growth rate than Walmart, although it is decreasing in the more recent years. I think I might add actually some extra columns there. So that is the problem. Yes, over the last 5 years it is up, but it's these most recent few years where it's a bit of an issue here. So I think we want to maybe reflect the sheet here. Whereas if we were to look at Costco revenue, WMT, WMT revenue. I'm just doing this on my other screen. Financials. You can see here that the revenue is still growing. 572, 611, 650, 680. So yeah, despite that the 5 years hasn't been as strong, but the most recent year they're still growing year to year. Net income, lowest. Highest margins, interestingly. Price to sales, it is the lowest. Price to book, it is lower. And PEG, it's lower as well. So yes, if you were to compare it to the multiples of Walmart and Costco, it would be a massive buy. But these are still growing massively.